It's early November, and you know what that means. You're about to get flooded with emails about year-end tax planning. I just got one this morning. 3 things you're supposed to consider as the year wraps up. RMDs are required minimum distributions. QCDs are qualified charitable distributions, lots of distributions, and the topic of today's video, the Roth conversion. I'm Daryl Rosa, and I lead a financial planning firm where my team and I help retirees navigate all kinds of situations, from straightforward plans to those that make you want to pull your hair out, to find the retirement path that fits them the best. First, a general comment about Roth conversions. Financial topics like this are challenging for a reason, and a big part of that challenge is because of how unpredictable life can be. The tricky thing is that none of us have a crystal ball. So here's my 2 cents right up front. Don't stress too much. Watch the video, run the numbers, and if converting IRA funds to the Roth tax-free environment feels right, then go for it. If it doesn't, that's perfectly okay too. We probably feel about the same. Just because something checks out on paper doesn't always mean we have to do it. So let's get to it. Here's the plan. First, I'll define what Roth accounts are. Then we'll get into the mechanics of a conversion and why it can be a tough and sometimes controversial financial move. And finally, I'll show you a few client examples to make this as practical as possible and share the exact considerations I look at before recommending anyone take this step. Often with moves we make to improve the future, it's not just about what the market will do next or how your investments are performing. It's more about a bigger, less talked about factor, how long you're actually going to live. Every financial decision you make, every step you take is ultimately influenced by this unknown factor. Roth conversions, for instance, can involve you paying some taxes much sooner than you may have planned. And one of the biggest determinants of whether this move makes financial sense is simply time. How long you'll be around to enjoy those tax-free benefits. For anyone unfamiliar with what a Roth account actually is, let me break it down in plain terms. Imagine your investments split into 3 buckets. First, there's your taxable bucket. This is where you get hit with a 1099 at the end of the year and you pay taxes on the gains and income each year. Then there's a tax-deferred bucket. Here you get a deduction when you make a contribution. It grows without being taxed, and then you pay ordinary income taxes when you take the money out. And finally, there's the Roth bucket. A Roth account is unique because you contribute with post-tax dollars, and that means you've already paid taxes on the money you put in. The big benefit: qualified withdrawals in retirement are tax-free. That's a huge deal if you're considering long-term family planning, because if your kids inherit a Roth account, they get that money tax-free. I've always thought the Roth accounts are more like a Main Street product for middle-income taxpayers, not a Wall Street one for more affluent people. And by that I mean there are income limits on who can contribute directly to a Roth IRA. If you're making too much money, you're cut off from contributing. Plus, you need to have some level of earned income. For 2024, you can contribute up to $7,000 or $8,000 if you're over 50. That extra $1,000 is what we call the catch-up provision. Roths are great family planning tools because let's say I wanted to set aside something for my 3 sons. Not saying I would, boys, if you're watching, but I could gift them each $7,000, which is within the annual gift tax exemption. If they each had at least $7,000 of work wages, they could put that money directly into a Roth. And because I married the first girl who would talk to me, or quite frankly, look in my direction, Jill and I could potentially gift them $14,000 each year. Boys, don't call me about this. It's just an example. So contributing is great, but there's also another route called a Roth conversion. A Roth conversion lets you take money from a traditional IRA and move it into a Roth, but there's a catch. You got to pay ordinary income tax on the amount you convert. So if your marginal tax rate is 22% and you convert $20,000 from an IRA to a Roth, you're looking at roughly $4,400 in taxes. Let's go to the whiteboard for a better explanation. I find this visual demonstration is the best way to explain to you exactly how taxes on your Roth conversion are calculated. This is a cylinder, the kind you would find in a science class. Drawing in science, not particularly my strong suit, so please don't mind the picture. Our tax rate is progressive, meaning the more income we have, the higher our marginal tax rate. That marginal tax rate is a tax you pay on the highest dollar of your earnings. So let's think about it this way. When you start to generate income, we fill up these bottom tiers first. We pay 10% on the first bit of income. We pay 12% on the next bit of income, 22 and 24. This is why this is so critical, because when you're doing a Roth conversion, you're throwing income on top of whatever your other earnings already are. So in that example where I said that we were going to do a $20,000 conversion at the 22% marginal tax rate, what that suggests is that we have filled in these categories. We have already earned enough income to use those lower brackets. That's why we're going to pay tax at 22% on the conversion. Of course, if we got up to that 24% bracket, then we'd be paying even more tax on the conversion. So these are the kinds of things we look at. There's a lot of different factors, which I'll explain as this video goes on, including sharing some client examples. However, the progressive nature of our tax system determines how much tax we pay if we want to do a Roth conversion. So the trade-off here is that from then on, that money grows tax-free. Roth conversions sound great in theory. Pay some tax now and your investments can grow tax-free forever. But it's not for everyone. And it's a move that can be hard to undo once you've made it. So there are multiple factors to weigh, including your current and future tax brackets, your retirement timeline, and even your health. Like I said before, this is a big financial decision, influenced by how long you'll need these funds. Let's look at some examples. This first one is fairly simple. $5,000 a month in spending. Social Security benefit is $26.44 a month with a spousal benefit of about half that. There's an income annuity that's going to pay $465 a month. That's ordinary income. And there's $200,000 in a Roth account and $200,000 in an IRA account. First thing I want to highlight is I'm initially comparing Roth conversions to fill the 12% tax bracket to a simple taxable, tax-deferred, tax-free distribution strategy. In retirement, the order with which we withdraw funds from the different buckets, taxable, tax-deferred, tax-free, is very important. So what you can see right now is there's about a 1% difference in the average tax rate. And the taxpayer would save a tick under $25,000 to do conversions, to convert up to the 12% bracket. The reason the advantage of doing conversions is so small here is because this person has done a wonderful job of splitting their assets in between Roth accounts and IRA accounts. Really what's happened is they've taken some of the tax hit already, they've spread it out over some of their working years so that when they retire, they're in a much better position. The other thing I can do is compare converting to 12% tax bracket to pro rata distribution, which would mean that the money they needed would 50% come from the IRA and 50% from the Roth. This improves the average tax rate a tick under 3%. They save some tax, but in cases like this, I just don't know if it makes sense to go through the exercise of doing the conversions. Let's take a look at one more thing here. If the taxpayer had $300,000 in an IRA and $100,000 in a Roth account, obviously there's going to be a little more benefit to doing conversions. In this case, I'm comparing converting up to the 12% tax bracket against taxable, tax-deferred, tax-free. So essentially, we're using that tax-deferred money first and letting the Roth money grow. And you can see we're saving a little bit of money, but I think it's important to keep in mind that this is $100,000 over a 25 to 30-year retirement. If the taxpayer is more conservative in their investment philosophy, as I'll share a little bit later, then we're probably going to have a harder time overcoming paying the tax up front. Often people get more conservative in their investment style as they age, and this can mean that there's more heavy lifting to do later on because of all the tax that was paid up front. In that first case, I likely wouldn't recommend conversions. What I often find with portfolios around the $400,000 mark or lower is that the tangible benefits just aren't substantial enough to justify it. This client had already done a great job with converting funds and saving in the Roth environment before retirement, and this will help minimize taxes for him during retirement. Now let's look at another case. This client has about $2.6 million, all in tax-deferred accounts. Here, there may be more potential for conversions. The first thing the system does is give us the most optimal, in terms of effective tax rate, bracket to convert to. So here, they suggest that we convert all the way up to one of the IRMA brackets. IRMA means that you're going to pay more for Medicare based upon your income. IRMA penalizes people with a lot of income. In this case, the system is suggesting that we go really high. We're not going to, nobody wants to, but let's look at some of the differences. So if we look down here, you can see that most of the tax strategies are going to have us paying an average tax rate of 21.45%. So this client happens to live also in a state that taxes retirement funds. And so between state tax and federal tax, they're going to be paying a lot of tax. All of these are suggesting that the effective tax rate would be 21.44 as you see me scrolling down here. It's not until we start doing conversions up to higher tax brackets that we start to see some savings. Now, it doesn't necessarily mean we're going to want to do them. But let's take a look at this Roth conversions up to the 24% tax bracket. This is going to be a big saving. So let me come up here or let me get rid of this. And then what I'm going to do is I'm going to go right here to the 24% tax bracket. So let's say this is the one we kind of want to look at. And you can see here that the average tax rate is going to decrease by 8%. We're going to pay a lot less tax. And the net legacy is going to go up. This part is important. Now, let me stipulate two things. First of all, what this is suggesting is that money in a tax deferred account that is inherited by your heirs they'll have to pay tax on that money, which is how it works. So the net legacy would be those balances less the taxes. Here's what I want you to know about the net legacy of any of these systems. Don't believe the numbers. Here's why. Because they assume a linear rate of growth. So they assume that money's going to grow. Let's say the portfolio is going to hit about 6.35% a year based upon the way the money is currently invested. That it's going to step up like that every year. Please do not believe that. That is not how money grows. We know that money goes up and down. We know that market returns go up and down. These numbers don't reflect that. But what we can look at when evaluating a Roth conversion strategy is, does it show that the net legacy number goes higher, that net legacy balance is improved? Is it better for our heirs? In this case, I would recommend the client convert up to 24% because what's going to happen over time is they're not going to pay any tax on their Social Security, and that's really going to help their money grow. I'd like to summarize by outlining a few things that turn me off about conversion. Number one, if you're too old, generally not a great idea. How old, Daryl? I wish I could tell you. It depends on a lot of factors. If you're very conservative, investments, not politics, I generally don't recommend doing a conversion. Remember, you're taking a big tax hit up front, and you need investment growth to help overcome the drag of that tax. Number three, if you make a lot of money, again, I can't give you a specific number, but if you're converting at a tax rate above 25% or in that range, well, that's a lot of tax to pay. I'm not sure if it's worth it. And lastly, if you've diligently invested in Roth accounts, a lot of the heavy lifting is already done. You may have done enough. So there you have it. My advice, don't let it stress you out. Roth conversions are a tool, not a necessity. And if it doesn't feel right for you, that's okay. For some people, they're a fantastic opportunity to lock in tax-free growth. For others, not so much. If you're confused, I feel your pain. Just because something makes sense, it doesn't mean you have to do it. All right, so now that you know how to weigh this important financial move, you're in a solid place to start making improvements to your retirement strategy. Of course, there's always stuff we couldn't cover here. So much more. If you'd like to see how our straightforward, transparent, flat fee fiduciary planning approach could help you and your situation, just click on the link in the description to book a consultation. Thanks for watching.